What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the famous bond trade. And this is going to be an important video because I know that there's a lot of interest in TLT, TMF, a lot of these bond ETFs that are or have been selling off quite aggressively as the yields have continued to push higher. So in this video, I really want to break this down and help you guys understand what is it going to take, right? What is it going to take for the yields to start going down? And what are the risks associated for the yields to stay higher for longer? I'm going to make cases for both. I'll let you guys decide and I'll tell you exactly what I'm personally planning to do moving forward towards the end of this video. So hope you guys enjoy it, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining and of course getting access to all the buy and sell alerts. There is a 16% annual discount that's available till the end of this month. And so 2 more days left, so you can access all the buy and sell alerts, options alerts, trade ideas, all the research and analysis, members only benefits, and members only private videos included as well. So link's going to be down below. So first things first, now you're starting to see headlines like these, right? So we've been talking about this for as long as I can remember, pretty much. We've covered so many things and so many topics from a macroeconomic standpoint. So everything that comes up is already been discussed in our community, right? So this one reads, expecting a recession, advisors say you can make a 40% return with a simple bond trade. Well, little do you know that it's not as simple as that, right? I mean, this report basically suggested that, as yields are going higher, bond prices are going lower, and eventually when the yields get cut, bond prices are going to go higher. I mean, it's not that simple, right? Because we already know that Bill Ackman is shorting bonds right now. He has been shorting bonds because he does expect yields to continue to go higher and prices to continue to fall. Because if you come over to how the yields have done, I mean, they have literally gone up since May, up over 39-40%, and TLT has gone in the opposite direction, right? So if I pretty much bring together both of these charts, in one simple pane, or basically just, putting them together, new price scale over here, you'll notice that they have moved in opposite direction. They they pretty much always move in opposite direction to each other. So you can see that TLT has been going down, and at the same time, the 10-year yields have been going higher. So that's the inverse correlation. That's exactly what they have listed over here in that report. The UK government bond price versus yield, same thing, same concept applies over in the UK as well. There's no differences over there. The concept and the fundamentals pretty much remain the same. Now, going over to this right here is the risk curve, which I think everyone needs to understand and exactly know what is going on, right? What is really going on from a risk curve standpoint, okay? Now, I want you guys to think of the 10-year rate, the 10-year yield, or the 20-year or the 30-year. So basically the bond, the treasury bond, as a base rate, right? That's basically what everyone can expect to earn with the taking little to no risk. You see, when I say little to no risk is because there's always risk. There's always risk present. Even if you hold cash, there is risk. The bank that you own, the bank that you hold cash in may go under, right? Things can happen. There's always risk. There's absolutely no free lunches in the market when it comes to not only investing, but literally as little as saving money. There's always risk involved, okay? So even though the 10-year yield is called the risk-free rate, it's not really risk-free because there's always risk, like I said. And what this basically tells us is that, okay, we right now are at a 4% level, right? This is where we are, 4%. That's kind of like a base rate. This is what everyone is looking to beat, right? I mean, the only reason you would invest in equities is to get something that's more than 4%, right? You want a higher reward, but for getting that higher reward, you're also taking on more risk, right? Because equities are more volatile, the return is not guaranteed. In this case, 4% is kind of guaranteed and backed by the US government. And the little risk that I mentioned, because it's not risk-free, that's because it's the US government, right? I mean, they've got a lot of debt, they've been issuing a lot of debt, and for that reason, we don't know, are they going to be able to pay back all that debt that they're issuing? Because in essence, when we are buying bonds, we are basically lending our money to the US government. They're borrowing from us, so their debt is our asset, their liability is our asset. So the risk involved is that whether they're going to be able to pay back, right? Because of all the debt that they've been mounting on over the years. Now, the problem begins when this 4%, right, which is supposedly risk-free, and you're not really doing anything to earn that 4%. You're basically lending it to the U.S. government, generating that coupon, generating those returns, that passive income. Right now, it's at 4.5%. The problem begins when this number starts to go up, right? When this number starts sitting at 6 or 7, right? Well, guess what happens then? Everything else on the risk curve starts getting pushed to the right. And the right is the x-axis, which is risk, right? Everything, whether it's real estate, whether it's the stock market, whether it's crypto, whether it's gold, whether it's, art, watches, doesn't matter. All asset classes that you know of start getting pushed more and more to the right from that risk analysis standpoint. Why? Because now they're competing against a very high risk-free rate. Everybody needs to beat a 6%, a 7%, an 8%. What would be the benefit? What would be the incentive as an investor? Why would I want to invest in something that gets me 6% and take on that additional risk when I can get 6% risk-free from the US government bond, right? That's the thought process that I want you guys to understand, is that the moment the yields start to creep up more and more and more, everything, all asset classes start getting shifted more to the right. So our discount rate will get pushed higher to 14% or 15% or 16%, because we need to be compensated for that higher level of risk that we are now taking and foregoing that opportunity to invest in the treasury bond. So hopefully that gives you a little bit of an understanding on how the risk curve basically works. And as the bond yields continue to push higher, it's going to put more and more pressure on equities. Now, that being said, this right here is the upcoming auctions. And I've been talking about this, why would the yields go up in the first place, right? Why are yields on the way up? Because there's a lot of supply for bonds, right? There's not a lot of appetite. There's not a lot of demand. There's not a lot of buyers for those bonds that are being issued constantly in the market, and they're circulating in the economy, right? I mean, what is the Federal Reserve doing at the end of the day? They're doing quantitative tightening. They're letting go a lot of their bonds that are sitting on their books. They're maturing, and they're not reinvesting that capital back into the bond market. So that demand is going away. While the Federal Reserve's demand is going away, the fiscal policy, which is run by the Treasury Department, they're issuing even more bonds, right? So on one hand, you've got demand going down. On the other hand, you've got supply going up. And this is represented by supply. So you've got auction amounts coming in, 64 billion, 71 billion, 44 billion. I mean, these are just numbers on a screen, but they have real impact, right? They're pushing yields higher and higher. And that's what's causing bond prices to continue to sell off. Now, this right here is another Charlie Beal posted this, talking about where the yields are. So 3-month is hitting its highest level since 2001. The 10-year is hitting its highest level since 2007. Now, the reason why the yields have stayed at 4.5%, close to 5%, 5.5%, is because we haven't seen these levels in a very long time. I mean, think about that for a second, right? If you are a bond trader, right? If you manage a portfolio of fixed income assets, a bond portfolio, right? You haven't seen yields this high in your career in over 16 years. I mean, 2001, that's 22 years. If you've been a bond trader for 22 years, you haven't seen a 3-month yield as high as it is right now. I want you guys to think about this logically, because look, the world doesn't revolve around us, right? It is a very big world. There's a lot of money around the world in trillions of dollars. There's a lot of hedge fund managers, a lot of pension fund managers. There's endowment funds. Everyone's got different, risk tolerance, time horizons, liquidity needs, financial objectives, right? So if you're a bond trader, you haven't seen these yields on 3 months in over 22 years. Guess what you're doing? You're buying them hand over fist. Why? Because the yields are high on a 3-month basis. I mean, we're sitting at, on a 3-month basis, we are probably going to be at over 5%. So that's going to be 0.3 MY on your TradingView platform. You hit enter. We're right now sitting at 5.5%, right? So we haven't seen these levels in a very long time. So that's why the demand is still pretty strong. But the moment it starts to get absorbed, right? The moment we start to see that demand start to taper off, because, everyone can only buy so many bonds, that's when the yields are expected to go even higher. That's what Bill Ackman mentioned, right? That's exactly what Bill Ackman talked about, that the yields are going to be higher. The 10-year, the 20-year, and the 30-year can potentially break to higher levels. Now, this right here is Peter Schiff. Now, I will take this with a grain of salt because he's almost always bearish. So definitely take this with a little bit of skepticism. And he says that on the date of this tweet, the yield on the 30-year treasury will still be under 3%. This was September 22nd. Half of my worrying had already come true, and the 30-year mortgage rates now exceed 7.5%. And this is what he says. He says bonds are getting killed, and the bloodbath is just getting started. The Treasury yield is 4.48%. The 10-year is what he's talking about. That's the highest level since October of 2007. The 30-year is sitting at over 4% as well, and the mortgage rates are sitting at 8%. Next year, he says, next year the 10-year Treasuries should be over 6%, with mortgage rates at over 10%, nearly 10%. Now, we don't know exactly where that top's going to be, right? I couldn't tell you exactly where we're going to go, how high we're going to go. But I can tell you what indicators to look out for and why I'm going to actually start to now dollar cost average a little bit into TLT and TMF. And the reason is because not because I expect this to be a top, right? Because we can certainly go even higher from these levels, but I do believe that higher for longer interest rates will start to put an impact on the economy now moving forward. There might be some indicators like jobless claims, unemployed persons, the GDP. As they start to come in, there is possibility that higher interest rates put pressure on the economy and its growth rate. And that's when the Federal Reserve starts thinking about potentially cutting rates next year. Because a lot of the thesis depends on where rates go, right? That's really where it is. Macro tactical plays like this, where we're talking about the bond trade, depends very much on yields and where are they going to go. And nobody knows the exact answer to that question. But we can look at certain other indicators to kind of glean into and understand, okay, what can potentially take place. I've already mentioned rates will get cut and the markets will rally, especially the bond market, if jobless claims start to go up, right? Unemployed persons start to go up. GDP starts slowing down. It starts coming down, right? Or we start to see inflation, core inflation starts to come down, right? It's up 2%. Or if there's a significant crisis in the economy, God forbid nothing happens, but if there is one, that's also going to result in yields coming down, rates getting cut. And there's also going to be a political year, 2024. That's also possible. There's some pressure on a political side that rates get cut and yields start to roll over. But these are some of the indicators that I'm watching. And higher for longer, the lag effects after 1 year, they're going to start to play a role. And if these things start to actually show up, there's going to be more and more likelihood that yields have or potentially have topped again, and they're going to start rolling over. Now, what's the worst case? What's the risk associated with this? Well, yields continue to push higher, right? This is an argument for rates higher for longer. And in a scenario that we don't see cuts and we don't see yields rolling over, that's going to be if there's no demand for treasuries, right? Unless rates become attractive. Now, so far we've seen demand. We've seen some reasonable demand. The auctions have been going strong, and treasury issuances have been bought up. But how long is that going to go on for, right? How long? How long is the demand going to be there? So this is a case where there's demand starts to fade and it starts to go away, and demand doesn't come back in until rates become more attractive, right? And by attractiveness, that's a very subjective number, right? It could be 5% attractiveness, 6% could be attractive, 3% could be attractive. Heck, 0.5% was attractive 2 years ago. That's what resulted in Silicon Valley Bank crashing and, of course, going under. So we don't know what that attractive level is going to be, the new equilibrium, once the current demand starts to fade. So that, again, is the top, right? That's going to be the attractive level. That's when the demand comes in. Prices start to go back up, yields start rolling over. Or if you get into a hyperinflation type situation where their inflation is really, really high and it's going crazy and there is strong economic growth, which both of them, I don't see how they can exist together. But if that scenario actually plays out, that's when rates can go absolutely crazy in that environment. So the first one's really going to be more of a debt crisis situation, which is, from a short, medium-term perspective, there's not a lot of risk involved. Ray Dalio has been talking about this. And then the second one is also very like a low likely outcome, right? From an economic standpoint. I mean, you can't have a strong economic growth and at the same time have hyperinflation. I just can't envision this. But these are possibilities, right? In the realm of possibilities, these are still possibilities. So the case for rates coming down over the next 12 months is better than the case for rates staying higher for longer and going even higher. So for that reason, I think the risk reward now starts to become a lot more tilted favorably towards TLT. And of course for TMF as well. So for that reason, I will be looking at finally dollar cost averaging a little bit into these, and we'll keep a close eye on the 10-year, the 20-year, the 30-year, the auctions, and what's going on with all these other indicators that I pointed out, like jobless claims, unemployment numbers, all those different things. So hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board. As always, happy investing, and I'll see you all in the next video.